Why is it so important this time around? Can you explain it to the audience? And how do you also seeing it impact the equity market?
Yeah, so you sort of did the work for me setting things up. Back in August, I think things really came to roost when the Treasury Department announced greater funding needs. And in addition to that, they announced that they were increasing the auction sizes for the 3-year, 10-year, and 30-year note, which is a lot of duration supply. Those longer end securities are riskier securities in the bond world. So we're going to have a repeat of that. The question that we'll be looking for is, are we going to see another increase in those auction numbers? Or will the Fed take into account, or sorry, will the Treasury take into account that yields have backed up quite a bit and maybe they should hold steady? But ultimately, they need to fund that growing supply.
So I want to talk to you just about the bond market in general. Are you looking at the bond market for opportunities? Is it the very short end of the curve, or do you want to lock in these higher yields on the long end?
Yeah, so we're right now overweight in fixed income. We love the front end. We haven't seen these yields in a very long time, and we're questioning when we should term out. But we'd like to get the picture on the supply side first.
I want to ask you a bit more about the bond market. So CNBC.com, great article. We have a look at the duration of bonds right now compared to what they were pre-pandemic. So back in 2019, the duration was longer. It was about 70 months. Now it's just 62 months. How does that shape both, again, the bond market and the equity market, especially with the announcement later today?
Yeah, so that's quite a shortening of the overall amount of debt. I think it's important to note that at higher yields, an individual bond actually exhibits less risk. So now's not the time to be underweight bonds, for sure. If you've been underweight, now's a good time to square up. And in terms of where you're positioning across the curve, we do right now like the front end a little bit better than the long end.
All right. So, Mimi, you don't do picks, but you did give us some areas and sectors that you're concerned about. I'm going to use concerned as a polite word. One of them is real estate. We got some big real estate news today. Right now, how do you see the investability of real estate?
So we're primarily worried about the commercial real estate side, just to be clear, because those don't have easy refinance options. And we have $1.5 trillion debt maturing in the next, from now till the end of 2025. So that's of concern. And we just think it's going to be a longer term drag on the economy with these higher rates kind of slowing that segment of the economy.
All right. So most of your concerns when it comes to commercial real estate, you're also worried about the consumer. How does that inform your thoughts about different sectors? Is there one sector that you see right now you want to stay away from?
Yeah, so primarily we're worried about the consumer, again, because savings have drawn down. The consumer has been extremely strong for the first part of the year, and that's been the great surprise. But at this point, the savings have drawn down. We have college loan repayments have started. Right. So I think it's more of a factor that these higher rates will be a drag.